Good morning and welcome to Charting the Markets on Tuesday, the 16th of January, 2024. Well, yesterday the US was shut for Martin Luther King Day, and overnight we had Asian markets coming off, with the Nikkei 225 finally seeing its first or second negative day of the year, and the Hang Seng index slipping through the psychological 16,000 mark and trading in 14-month lows. And this was on the back of investors worrying when the first Fed rate hike might be, because so far we've anticipated a rate hike in March of this year, but this might actually be pushed back as investors are looking forward, and also the Fed, towards US data such as retail sales later out on Wednesday. And what we also saw yesterday in Davos is that ECB policymakers have had a more hawkish tone, with some of them, like the ECB's President Holzmann, saying that no one should count on any rate cuts this year, and all of which led to equity markets coming off in Europe whilst the US was shut. And the fact that President Trump also had a large victory in Iowa basically leads investors to believe that there could be a lot of policy volatility over the coming months in the US, as well as the election there election process gets really underway. Now, with regards to the UK, we saw that basically this morning the unemployment rate stayed the same at 4.2% for November, but we also saw that wage growth was slowing down, which is positive. And you can see, despite that, the FTSE 100 daily financial bet here keeps on sliding and has now fallen through the red line here, the 200-day simply moving average, 7,572, and is currently falling through the October to January uptrend line, and has so far slid to 7,535, which incidentally is where the mid-November high was made. Now, from a technical perspective, if today we were to close below this uptrend line and also below the orange line here, which is the 55-day simply moving average, both of which come in at 7,557, then the odds are pretty high that we might slide further towards the psychological 7,500 mark, and perhaps even touch the early November high at 7,485. So further downside pressure likely to be in store for the FTSE 100. For this to be negated, what we would need to see is a rise back above the 200-day simply moving average at 7,572, and ideally also a rise back above Monday's high at 7,642. But as you can see here, we are a long way off there. Now, I mentioned the Hang Seng, and you can see here the Hang Seng trading lower, continuing its decline and having now fallen through its December low, and thus trading in 14-month lows. As you can see here, we are heading back down towards the November 2022 lows, and also the October 2022 low at 14,582, having earlier in November already slid through this key support area, which went back to June of 2012, around the 18,000 mark. So the Hang Seng very much bearish here, with further downside likely to be seen, provided we stay below the last reaction high, that is to say a high which is higher on the daily candlestick than the one to its left and to its right, and that was made on Thursday of last week at 16,445. Provided we stay below there, further downside is likely to be seen for the Hang Seng. And if you look at the US, though, the picture is quite different. Here, the Dow Jones Industrial Average last week made a new all-time record high at around 37,825 on the daily financial bet. But even here, it looks as if after 3 consecutive days of fall, now don't forget, one of these was on the IG chart here, where you could have traded out of hours whilst the US market was shut yesterday. But apart from that, we had 2 consecutive days of falls already last week, which may be added to this week. Today, as you can see here, we're sliding further. We're currently testing the 11th of January low, and if we were to fall through there, we could actually slip back to the current January low at around 37,218. with regards to the Dow Jones Industrial Average. So that is a distinct possibility, as we find it difficult to break through the 37,800 mark, which capped back in December and again earlier this month. And if you look at the, if you look at the NASDAQ 100, which I also wanted to mention, you can see the picture being quite similar here. We are slightly drifting lower here, having basically been capped around the 16,880 mark over the last 3 days. And here the line in the sand is Thursday's low at 16,614, because a fall through here would most likely lead us to fall back towards the 16,500 mark. But as long as we stay above the last reaction low, a low which is on the candle lower than the one to its left and to its right, which was made last Thursday at 16,614, provided we stay above there, we may actually continue our advance towards the psychological 17,000 mark over the coming days. The US dollar has started to strengthen over the last few days as interest rate cut expectations by the Fed have been pushed back by market participants, and you can see the impact of that on several currency pairs, and one of which is the euro against the US dollar. And as you can see here, we are now being pushed lower quite significantly and have fallen through the November to January uptrend line earlier this morning at around 109.30 and slid all the way down to the orange line here, the 55-day simply moving average at 108.86, which together with the low seen so far at the beginning of January at 108.77 acts as a support area. But it looks to me as if we're going to fall through it, in which case we could touch the 200-day simply moving average here in red at 108.50. So further downside quite likely with regards to the euro dollar as the US dollar continues to strengthen, and as these rate cut expectations by the Fed are being pushed back by market participants. Now, for the picture to become bullish again, what we would need to see is a pretty unlikely rise above last Thursday's high at 110.01. Only then would we reassume our uptrend in which we'd been trading since October of this year. But right now, it looks far more likely that we're going to slide through the 108.77 low, the current January low, in which case the 200-day simply moving average will be in focus at 108.50. And perhaps we could even slide all the way back down again towards the early November high at 107.56. And the picture is quite similar with regards to the British pound against the US dollar. And as you can see here, the price of cable has also fallen through its November to January uptrend line at around 126.90 and is currently heading back down again towards the early January lows at 126.11. And below there, we have potential support coming in along the orange line here, the 55-day simply moving average at 125.81, and then also around the 200-day moving average here in red at 125.49. So these are potential downside targets were we to fall through 126.11, the current January low. And here, only a rise above last week's 127.86 high would reassert the uptrend. And that looks pretty unlikely at the moment. It looks more likely that we're forming some sort of head and shoulders pattern here, in which case we could actually slide quite a way lower over the coming weeks and perhaps retest the early November high at 124.28. if indeed we were to see a fall to below 126.11 take shape this week. Another currency pair which is really interesting at the moment is the Australian dollar against the US dollar, because it made a 5-month high at 68.71 back in December, but since then has started to slide quite significantly and basically has done so on the stronger dollar, but also on the back of Australian consumer confidence data worsening, and we saw that earlier this morning, and this pushed us through this October to January uptrend line around 66.34 and towards the red line here, the 200-day simply moving average at 65.84. So that's the next downside target, ahead of the December low, which was made at 65.25, and also the early November high at 65.23. So that's a potential downside target area for the Australian dollar against the US dollar now that we've fallen through this uptrend. And again, here for a bullish reversal to take us higher again, we would have to rise above Friday's high at 67.28, which looks pretty unlikely at the moment. The stronger US dollar has had a negative impact on the gold price. And if we look at the daily financial bet of gold, you can see here that we are starting to come off, having risen to $2,062 per troy ounce only on Friday of last week. And here we seem to be topping out once again and heading lower again towards perhaps the 3rd of January, lower to $2,031 per troy ounce. That is a possible downside target ahead of a potentially more important support area between $2,016 and $2,014 per troy ounce, which are the current January lows, as long as we stay below Friday's high, $2,062. So here we can see a reversal to the downside on that stronger US dollar, with the gold price sliding, and despite heightened Middle Eastern tensions not being able to prop up the gold price at the moment. So you can see here we are pointing down as well on this chart. Now, this is not the case for WTI. As you can see here, the price of crude oil is advancing on these heightened geopolitical tensions in the Middle East. And we can see that we are potentially heading back up again towards the $75.27 high from last Friday. But before we get there, we've got the orange line here, the 55-day simple moving average at 74.37, which is a potential upside target. And also this resistance line going back to November of last year, which comes in around 75. And once above that, we've got 75.27 on the futures contract here, which is the next resistance area. And we can see that we're trading in a sideways trading range and potentially within a triangle. And if that were to be the case, a break above 75.27 would actually mean that not only we are likely to take out the December high at 76.20 and also the 200-day simply moving average at 77.51, but most likely head all the way back up again towards the mid to late November highs at 79.62 to 66, if indeed we have a bright triangle breakout to the upside. Now, this hasn't happened yet, so we can't jump the gun here, but it is interesting to see that whilst we stay above yesterday's hammer low, which was made on this daily candlestick here at 71.38, whilst we stay above there, the odds are higher for a advance to be seen over the coming days than any further sideways trading with a downside bias. So short term, on heightened geopolitical tensions, we see a rise in the oil price despite a unclear future demand picture emerging, especially since the Chinese economy, the world's largest importer of oil, remains quite lackluster at the moment. And last but not least, let's have a look at corn, because US corn prices are dropping even further. And if I zoom out onto a quarterly chart, you can see here that we are trading at levels last seen in October of 2020. And perhaps I'll make it clearer here if we look at the weekly chart. We've been falling through some really good support area going back to July of last year and are now slipping quite significantly, as you can see here. And if we look at the daily chart, you can see that we so far fell on the front month futures contract to 448 and are heading towards the further downside to levels last seen, if I go back to my weekly chart to make this clearer, around the November 2020 high, which was made around 438 on this futures contract. So that would be the next downside target. And then below there, we've also got the late November 2020 low at 414, which is another potential downside target for US corn. And as you can see here, as long as we stay below this June to January downtrend line, the trend's your friend, and that is still pointing down for US corn futures. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is AxelR_IG.